We all need a roof over our head every night when we put our head on the pillow to go to sleep. Some people own that roof and some people rent that roof. Here is the challenge. Some people rent because they do not know they can afford to buy, and that is sad. Others rent because it's right for them. It is true. Home ownership is not right for everyone, and that is okay. However, I truly believe if you want to create wealth, and when I say wealth, I mean generational wealth, you need to own real estate. Welcome to episode 141 of the Martini Mortgage Podcast. My name is Kevin Martini. I'm a certified mortgage advisor with the Martini Mortgage Group, which is located in Raleigh, North Carolina. However, myself, along with a very talented crew of mortgage professionals, help families in all 100 counties in North Carolina and pretty much in every state in the U.S. too. I'm calling this special episode of the Martini Mortgage Podcast The Big Opportunity. I want to start by sharing there is a time to rent. However, that time is not now. But as I mentioned, homeownership is not right for everyone. I get sad when people rent because they don't think they have the options to buy. Let me share this fact. Every day I help families secure a home loan with less than 20% down payment. Every day I help families secure a home loan with less than perfect credit. And many first-time home buyers are eligible for a first-time home buyer tax credit. If you are a renter, you owe it to yourself to explore the options and then make a decision if homeownership is right for you after you have all the facts, because there's never a substitute for getting educated on your homeownership options. I share this so you know I am here, and it is a big opportunity to explore your homeownership options if you are a renter. But an even bigger idea, or the big opportunity of this episode, is to create generational wealth with real estate rental portfolio that creates passive income, provides tax benefits, and provides asset appreciation. Passive income, tax benefits, and appreciation, oh my, sounds too good to be true. But it is true for many of the families I work with as their certified mortgage advisor. Now, before you start thinking of all the reasons why this episode of the Martini Mortgage Podcast is not right for you, and before you start reciting in your mind all the reasons why you can't afford a piece of investment property, let me share this fact with you. It is my opinion you cannot afford not to have real estate investment portfolio, even if it's just for one property. Please give me your ears to expand on this big opportunity. Let me start with a fact. Investors are behind 33% of the purchases of single-family homes today in the U.S. So that means 1 out of 3 single-family homes are purchased by an investor. Now, the Martini Mortgage Group has its headquarters in Raleigh, North Carolina. And in Raleigh, nearly 1 in every 4 properties are sold to an investor based on the most recent data, which is from the fourth quarter of 2021. Yes, this is an amazing stat, and it highlights a big opportunity for you, and it's not too late for you to take advantage of this big opportunity. I am a real estate investor, and I share this not to impress, but impress upon you that I have firsthand confirmation that it is easier to make $1 million with real estate than it is at your 9-to-5 job. To purchase all of my family investment properties, I use one of the most powerful tools available, and that is leverage. Simply put, leverage is the use of borrowed money to secure an asset to amplify the potential return on investment. Let me get granular. Let us say I want to purchase a single-family home and make it an investment property. I put 20% down payment and I secure a mortgage for 80%. My 20% down payment means I am leveraging 80%. Oh, by the way, the 20% down payment is used only for illustration on purchasing an investment property. If you are purchasing a primary residence, you may not even need to put a down payment, or if one is needed, it may be 3 to 5%. So your leverage could be as high as 95% to 100%. Now that you have the working knowledge of leverage, let me start to chat about passive income, tax benefits, and asset appreciation. I believe to become wealthy and to create generational wealth, you need to have multiple forms of income streams. One obvious income source is from your job. This is active income. You have to actively be doing something like going to work and doing your job to create active income. Then there is passive income. I define passive income as income earned outside of your job. One way to earn passive income is by owning a rental property or properties vis-a-vis positive cash flow. Let me illustrate. You purchase a $250,000 rental property and you leverage 80% of the purchase, which means you put 20% down, and that is $50,000. And you secured a $200,000 mortgage. For illustration, let us assume a 7% interest rate for a 30-year fixed. Again, this rate is only for illustration. A $200,000 30-year fixed mortgage would have a principal and interest payment of $1,131.60 a month. Let us assume that the property tax and the homeowner's insurance is $3,000 a year, which is $250 a month. This means your total mortgage payment in this hypothetical example would be $1,582 a month. Let us assume the repairs and miscellaneous things like advertising the property, let's assume those cost $2,400 a year. Now for me, I factor in 1 month of mortgage payments to cover for vacancy. So the operating cost, let me round up and say $4,000 or $334 a month. A conservative rental in Raleigh would be, let us say, $2,000 a month. Perhaps that is too conservative, but let me go with it. You are paying principal, interest, tax, and insurance of $1,582 in this example, and we are forecasting $334 a month for incidentals. So that is $1,916 a month. So worst case with this conservative rent of $2,000, you would have passive income of $84 a month, or be positive cash flow $1,000 a year. What if the rent was more realistic at $2,250 a month? You would be creating $2,250 a year of passive income vis-a-vis positive cash flow from your rental property. But as they say in those infomercials, but that is not all. There may be the potential for major tax benefits for owning a rental property. Know that I'm a certified mortgage advisor, not a CPA or certified public accountant. So please consult with your tax preparer. With that said, for me, owning rental properties allows me to deduct my operating and owner's expenses. Plus, I get to depreciate the property, and I have capital gain deferral. I don't want to go too deep into this, but I do want to talk about the power of depreciation deduction. You see, the current IRS code allows one that owns a rental property to depreciate over 27 and a half years. Let me use that $250,000 rental home I mentioned earlier. $250,000 divided by 27.5 equals $9,091. You can use that depreciation expense to lower your tax liability along with your other expenses. Yes, the tenant is paying for your mortgage and providing you with passive income with positive cash flow. You are getting tax benefits, and that is not all. You will also get asset appreciation through the appreciation from your rental property. Now, before I dive deep into this, let me address two topics that are top of mind for some people that are concerned about real estate today. Number one is some people are concerned that there will be a recession, and the recession will impact home values negatively. Some people fear that we are approaching a real estate bubble. Let me address the bubble. Today, we are a materially different market than we were 15 years ago. The demand for homes today is real, unlike the artificial demand created by lower lending standards before the Great Recession. In short, it is my opinion the Great Recession in real estate was created by many unqualified borrowers being able to secure a home loan, and that home loan went into foreclosure. Today, you need more than a pulse to qualify for a mortgage, and the bad industry actors have been flushed out. However, there's going to be a recession. It is not if a recession will come, because recessions are a natural part of the economic cycle, and it will come. However, recession does not mean housing crisis, nor does inflation mean lower home values. As I'm recording this episode, inflation in the U.S. is at a 40-year high. Owning real estate is a hedge against inflation. In fact, tangible assets like real estate tend to increase in periods of high inflation. Speaking of home values now, I have found that the best and the most accurate real estate value predictor is the Home Price Expectation Survey by Pulsenomics. It is done every quarter, and it's not one person's opinion on where home values are headed. It's a panel of over 100 plus economists, housing market analysts, and investment strategists, and they're surveyed, and the result is the Home Price Expectation Survey. In the most recent survey, basically they are forecasting a cumulative 25% increase in home appreciation through the end of 2026. Let me share what that means using that $250,000 investment property we talked about earlier. If you would have purchased it in January 2022, then by the end of 2026, according to the Home Price Expectation Survey, it would be worth $346,342. So during a period of 5 years, your potential growth in wealth, solely based on appreciation, would be just under $100,000. Then pepper in the passive income received and the tax benefits, and you are creating generational wealth. Wow, that was a lot, wasn't it? Now you know why I called this episode The Big Opportunity. I believe in owning your dream home, and I help families secure the right financing for their dream home. I also believe in investment properties, and I help families deploy the right financing strategy for their real estate investment portfolio. I know it should always be home loan first, and then go find your house. So with that said, let us connect to talk if investment properties are right for you and your family. My name is Kevin Martini, and I'm a certified mortgage advisor with the Martini Mortgage Group. I provide trusted advice with a frictionless process that offers great rates and certainty to you and your family. My number is 919-238-4934. Looking forward to connect. Stay safe out there, and wishing you peace and blessings. Now it's time for this disclaimer. The material has been prepared for marketing purposes only. This is not a loan commitment or guarantee of any kind. Loan approval and rates are dependent upon borrower's credit, collateral, financial history, and program availability at time of origination. Rates and terms are subject to change without notice. The Martini Mortgage Group at PCL Financial is a division of Celebrity Home Loans, NMLS 227765, with a branch address of 507 North Blunt Street, Raleigh, North Carolina, 27604. You can contact Certified Mortgage Advisor and Producing Branch Manager Kevin Martini, NMLS 143962, by calling the branch, and that number is 919-238-4934. For a full list and more license information, please visit www.nmlsconsumeraccess.org or by visiting www.martinimortgagegroup.com. Equal housing lender.